It's very difficult to know what time frame to use when looking at the market. If you use one time frame, it might tell you one picture. If you use another time frame, it might tell you another picture. I don't know what the right answer is. I don't know what time frame you're supposed to use when with 100% certainty. I use different ones at different times when looking at things. But what I do know is in the past few days, I've seen several instances where in the very short time frame, I'm talking few minutes, post very critical events, the market has done one thing, and then as that timeline was extended a little bit farther out, something else happened. Something more fundamental based happened, and happened in a bigger way. Why does time even matter? Well, I before had maybe not thought time would matter, but you work with the market you have, and there's definitely an important aspect of time to this market. You look at the peak for the biggest companies in the world, number one, Big Kahuna, Apple, for example, it peaks January 3rd, 2022. It bottoms just about January 3rd, 2023. Just about. As does Microsoft, as does Tesla, and many other companies, depending on exactly what their characteristics are in terms of growth and value and various other aspects and valuation, etc. But I want to talk today about two very important time frame events I've seen, because I am a fundamental investor and it's been very difficult to be a fundamental investor, but we know that's not always the case. The fundamentals win out in the end. At least that's what it's been like so far in my life. That's what I've seen. That's what I believe to be the truth. Over time, means revert, meaning if something goes too far relative to its fundamentals, it will revert to the mean, the opposite in the other direction. And today we're seeing a little bit of that on the broad market stage. We're seeing the companies that have performed the most in the Fed minutes that were discussed when they talked about the S&P, that the S&P had done well, but it was led largely by a few mega or large market capitalization companies, I believe was their exact terminology. That's where the outperformance was. So that's why the S&P 500 was strong. That was in their Fed minutes. And those companies are weak today. Basically everything else is strong, or a lot of other stuff is strong. And I'm not so sure that's supposed to be the case, because, and we'll get back to the two instances of inefficiency that I saw in markets with time frames over the past couple of days. But I don't think that's supposed to be the case, because, over maybe just a few weeks ago, I thought the reason why the market was so concentrated is because these companies were doing so well and were going to continue to do so well that the rest of the companies didn't really matter. So now all of a sudden, we're confident that the rest of the economy, the rest of the market, I should say, which by and large experienced an earnings decline in Q1 when GDP was strong, is going to be so good now. I mean, just one more statistic for you. The Russell 2000, 40% of the Russell 2000 is unprofitable. Considering bankruptcies are now starting to pick up, and I have that chart as my pinned tweet, I'm not so confident about that index. And that index was down quite a lot last week. It's up quite a bit today. I'm not viewing today's action in terms of just, browsing the market as anything to, be too married to. I do think the mega cap correction will continue. I think that's good, but I don't think the exact way today played out is the exact way in the future. And I think that leads us into our next point. Let's talk about what happened today in the morning. Vice Chair Barr decided to increase capital requirements for banks, particularly large regional banks in the space of $100 billion to $700 billion. They got this new requirement. In no way or world does this make stocks, bank stocks, more attractive, more profitable. In no way does it do that. It makes them less profitable, I believe, assuming I have the situation correct. If banks make money through financial activities such as loans, and they're now required to take less of their reserves, less of their deposits, and loan it out, so they can loan out less money that is now regulated into this large section of banks, then you would assume those banks will make less profit and be worth less as stocks. Because if they're losing money and they're going out of business, they ain't worth nothing. They ain't worth nothing. So they're not worth more here. Maybe there's a little bit of, pressure off the chest, but that doesn't explain, one, the stock move. You look at the KRE stock. It has a very aggressive move first thing in the morning up until 10:10. 10 minutes after the announcement and just a few minutes after Vice Chair Barr starts speaking. Then you see a dip, a big move up, and just a downtrend basically the entire day to the last 5 minutes of the market. You look at the equal weighted S&P 500, you see a similar thing, though not exactly the same, but a peak just about at the same time of the banks. Okay, I don't know what that morning buzz is about, but been there, done that. We've seen plenty of morning rallies. And the equal weighted S&P saw its morning rally and then was down from that. Just putting that out there. Anyways, the other side of this coin, this exact coin, before we get to the next point, or the next example, is the same thing happened with yields. We pull up the 10-year Treasury yield. It gets this piece of information, this change in information, and the yield falls. Why would the yield fall? This makes no sense. If anything, the banking system is becoming more stable because of this, but there'll be less money being lent. So people will have to offer, the market will have to offer, people going into the market to raise debt will have to offer higher yields to get a smaller share of the total lendable cash. Again, didn't make much sense. Yields are down today across the board, although they're struggling to find direction. They ultimately end up in a uptrend breaking out. That's the truth of it. Even though today was a very strange pullback from that Barr event. Very strange, in my opinion. We'll see if one day ends up being super important. Time will tell. The Fed spoke a lot today. A lot of members speaking. I'm very much under the impression they are hawkish. I get it. A lot of market participants and the market overall have had very different opinion. I assume most of you have been watching these videos long enough or have seen enough of these videos to know where I stand. And maybe you have or have not seen how the Fed has ended up playing out. But we'll see how the Fed continues to play out. So I think the Fed's ultimately going to remain hawkish. That leads us to our next point. Last week, the Fed released the Fed minutes. The Fed minutes, initially, in the first few minutes after they were released, as everyone's just got this anxiety in that few minutes. There's activity. There's eyeballs everywhere in the market. Not a single person reading the Fed minutes. They're just making moves. Activity, liquidity is occurring. Exit or entry liquidity, who knows? But that is occurring, and the market's rallying up. And then, just a few minutes later, you get a quite steep and quite aggressive pullback. And then that ends very abruptly by the people who didn't read the Fed minutes. The Fed minutes being the notes and in-depth opinions citing what various groups and sizes of these groups believed in the Fed minutes. And we ended the day pretty flat, no different than where we were pretty much before the Fed minutes. However, it kicked off a quite strong move in bond yields that was enough to bring the 10-year back above 4% and the 2-year to the highest since, I believe, 2006 or possibly even 2000. Those were just about the only times the 2-year was in this range, around 5%. 2006, 2007, and 2000. Pretty important market events for very speculative periods in markets when, in my opinion, we are currently experiencing investment styles that are not focused around actual cash flow returns, the essence of an investment. At a time when bonds are offering the best cash flow returns that they have in, seems like, decades. Just a few times in the last decade have they been any better than this in terms of actual cash flow. Yet the opposite side of the seesaw is also very high. It's very strange. It's very strange. It's like pricing in perfection at the same time trying to get an economy to slow down. It's a very, very strange situation going on. That's just my opinion. But those are the things I'm thinking about. Those are the things I'm seeing. Those are my in-depth reads of catalytic events that have happened in the last couple of days that I've seen back and forth market reactions on. And we don't normally see that. That is a pretty interesting thing. Normally it's way more clear-cut. The Fed minutes reaction was definitely not clear-cut. We finished that day green, and then we had 3 red days in a row. So I believe 3 red days in a row. It's been a ride. It's been interesting. We'll see how the next coming weeks develop. We've got a CPI report this week. I have no idea how it's going to come in, but I think it will just be a one-day thing. We saw, PCE. We pulled back. Things have happened. So you look at Tesla delivery numbers. We're now lower than we were, delivery numbers. I think it could be one of those. Time will tell. I've shared what I think about the Fed. I've shared what I think about overall market pricing relative to bonds and various other aspects and what we need to actually price in and get to achieve those prices. And we'll see what happens. That's what we have to do. So I'm not perfect. Please know that. I'm not trying to imply that I'm perfect. I'm just sharing with you my best thoughts. So that's today's video. And until next time, peace out.